Australia sits on some of the richest mineral wealth on the planet. Iron ore, coal, lithium, gold, copper, all pulled out of the ground and shipped to the world, generating tens of billions of dollars in export revenue every single year. The country's biggest mining companies are worth hundreds of billions of dollars, and the industry as a whole hands over more company tax than almost any other sector in the Australian economy. It looks like the ultimate wealth generating machine. Dig a hole, find something valuable, get rich. But behind that image is a business with some of the highest barriers to entry of any industry on earth, a tax and royalty system that takes a serious cut before you see a cent of profit, and timelines so long that some projects take over a decade before they produce a single ton of ore. So, how does a mining company actually make money in Australia? Let's break down the economics. Before you can dig anything, you need the legal right to dig it. In Australia, the states and territories own the minerals beneath almost all land, even land you privately own, and to extract them, a company needs a mining tenement, essentially a license granted by the state government giving exclusive rights to explore or extract minerals within a defined area. Getting one of these tenements typically starts with an exploration license, which lets a company survey and test an area without yet committing to full-scale mining. Only after exploration proves there's something commercially viable down there does a company apply for the much more expensive mining lease that actually allows extraction. This exploration phase alone can be a multi-million dollar gamble with no guarantee of a payoff. Drilling, geological surveys, environmental baseline studies, and native title negotiations can run for years before a company even knows if the deposit is worth mining. Most exploration projects in Australia never make it to production at all. If exploration does confirm a viable deposit, the next hurdle is native title. A huge portion of Australia is subject to native title rights held by Aboriginal and Torres Strait Islander communities, and mining companies are generally required to negotiate Indigenous land use agreements before development can proceed. These negotiations cover compensation, employment commitments, and heritage protection, and can take years to finalize. Skip this step, get it wrong, or damage a heritage site during operations, and a mining company can face not just legal action, but reputational damage that follows the company for years. Then comes the capital cost of actually building a mine. This isn't a warehouse and a checkout counter. Depending on the commodity and scale, developing a single mine site, roads, processing plants, rail or port infrastructure, workforce accommodation, can run from tens of millions of dollars for a small operation to well over $1 billion for a major iron ore or lithium project. This is why so much of the Australian mining industry is dominated by a handful of giant companies, and why most new entrants either partner with a major player, seek significant outside investment, or list on the stock exchange specifically to raise the capital needed to get a project off the ground. Once a mine is operating, the revenue model is refreshingly simple, at least on paper. You extract a commodity and you sell it, largely to international markets, with Australia's biggest customers historically being China, Japan, South Korea, and India. What makes mining genuinely different from most other industries on this channel is the margin. While the average Australian business operates on profit margins in the single digits, mining companies have averaged pre-tax margins of around 28% over the past 2 decades, nearly 3 times the margin of the rest of the economy combined. But that headline margin comes before two very significant deductions: royalties and company tax. Royalties are the first cut, and they're not technically a tax. They're a payment to the state government for the right to extract a resource that the government owns on behalf of the public. Every state calculates royalties differently, and rates vary depending on the commodity. Iron ore royalties in Western Australia sit around 7.5% of value. Coal royalties in Queensland and New South Wales range from around 7% up to 10% for higher value coal. Across all states and commodities, the effective royalty rate averages around 6 to 7% of production value nationally. On top of royalties comes standard company tax at 30% on whatever profit remains, the same corporate rate every other Australian business pays. Offshore petroleum and gas projects face an additional layer again, a profits-based charge called the Petroleum Resource Rent Tax, aimed specifically at large offshore oil and gas developments in Commonwealth waters. Combined, royalties and company tax mean the mining industry contributes an enormous amount to Australian government revenue, with recent figures showing the sector handing over around $65 billion a year in company tax and royalties combined, split roughly $40 billion in federal company tax and $25 billion in state royalties. For context, that single industry's contribution funds a meaningful share of the hospitals, schools, and infrastructure Australians rely on every day. It's also worth noting a persistent point of debate in Australian politics. Despite these enormous tax and royalty payments, mining companies also receive significant government support, most notably through fuel tax credits, since most miners pay little to no fuel excise on diesel used in off-road operations, a concession worth billions of dollars to the industry each year. So even with a genuinely strong underlying margin, mining is far from a simple wealth machine. The path to profitability runs through years of unpaid exploration risk, a native title negotiation process that can take just as long, capital costs that lock out all but the best funded operators, and then a royalty and tax structure that takes a meaningful slice before shareholders see a return. And even once a mine is up and running, profitability is entirely at the mercy of global commodity prices, something no individual company controls. Iron ore, for example, has swung from over $200 a ton in 2021 down to around $100 to $120 a ton more recently, a swing that can turn a highly profitable year into a mediocre one without a single change to how the mine itself is run. So, is owning a mining company the ultimate Australian wealth play? The economics can genuinely be extraordinary. Margins nearly triple the rest of the economy, backed by some of the richest mineral reserves on the planet. But getting there requires clearing a gauntlet almost no other industry demands: years of speculative exploration spending with no guarantee of success, a negotiated agreement with native title holders before you can even break ground, and capital requirements that run into the hundreds of millions before you've sold a single ton. The companies that dominate Australian mining aren't the ones who simply found something valuable in the ground. They're the ones who could survive a decade or more of cost, negotiation, and regulatory process before that value ever turned into revenue.